Hello, everyone. This is William Chettle with Symmetry Partners, and I want to welcome you to our 2021 Mid-Year in Perspective. This is timely education, insights, and analysis, and we're going to look back not only what happened in the last quarter, but what's happened in the first half of 2021. And I'm joined today by Casey Dillon. He's our Director of Investment Communications and also the COO of the Symmetry Panoramic Funds. But really, I like to think of Casey as our Director of Explaining Things, and he has a great way of putting often very complicated concepts in simple and easy to understand terms. And Casey, it's certainly been quite a quite a ride this first half of the year with worries about inflation, the economy is going gangbusters, or it's not going fast enough. All kinds of concerns about things like the Delta variant, and yet the market overall has done reasonably well over the last 6 months.
It certainly has. And I know that you and I were having a conversation not too long ago about the fact that over the short term, the market is a voting machine, right? Over the long term, it's a weighing machine. It's weighing earnings. But over the short term, it's a voting machine, and it's tallying the votes that are cast every second of every day that markets are open. And so what we're observing playing across the market is people voting with those dollars, and they all have sort of different interpretations of what's good news, what's bad news, what they think the future is going to. And sometimes a coalition of them will get together and they'll vote in the market, and you'll see the market move one way or the other. So there's a lot of tension in the marketplace playing out that we are observing on a day-to-day basis.
And even some recounts.
Even some recounts. And as you know, we get together on a quarterly basis to sort of look back and have some understanding of what was moving markets, how markets behaved across sort of geographies and asset classes and the underlying factors that drive them. And then we sort of review some of the headline things that are motivating people's votes that they make with their dollars. And that's what we have prepared today as well.
Beautiful. And if you do have questions for Casey, we will be taking them at the end. Just please type them into the chat panel, and we will get to them in the order they come in. And the other, just quick reminder, is that we have a copy of the presentation under the handout section. So if you'd like to download a PDF of the slides Casey's presenting and follow along at home, that you can do that as well.
Okay, shall we? So it has been an interesting quarter for the second quarter, and it is sort of an interesting area of performance that we look at in the context of how the year has been, and really sort of over longer periods of time. And so the way that we think about analyzing the performance to markets is to start at sort of a 30,000 foot level. And we look at the dichotomy of stocks, equities, and bonds or fixed income. And we look at that along the lines of geographies. And that helps us start to understand how markets are performing in the short term, but also over time, gives us context for understanding that. And so as we look at market performance in the second quarter, what we observe is a continuation of how markets really have been performing for some time. In fact, if we look back over time, the past 10 years, for instance, it's been U.S. equities that have outpaced international developed markets and emerging markets. And we see a resumption of that in the second quarter with U.S. markets outperforming. However, that actually is a juxtaposition to how markets have been behaving for, let's call it, the past 6 to 9 months. Mm-hmm. Really since November, with the announcement of a viable vaccine, ultimately viable vaccines being brought to market. Immediately what we saw was a change in markets as market participants who are sort of forward-looking, forward pricing, started to see a light at the end of the tunnel. And we saw emerging markets in particular do particularly well, international developed markets do well, and U.S. markets continue to perform strongly. But it really was emerging markets that took off from that bottom. And what we've seen is sort of a cooling across all markets in the second quarter, with U.S. kind of resuming that pole position. And there are a number of reasons for why that is that we'll get into as we sort of look at the headline items driving news. As we look at the performance over the 1 year period it has been remarkable, frankly. Performance that we've seen has been historically strong, and really it that runs longer than the 1 year period. We're now a year and a quarter removed from the bottom of the COVID-induced lockdown. And so what you observe with the orange bars, for instance, is a continuation of the strength of markets recovering from that market bottom as market participants look forward and price forward for a recovery across the globe. Interestingly, as we look at fixed income markets, we also see some of the same themes that were moving equity markets playing out in fixed income. In particular, sort of a sideways movement in U.S. Treasuries and U.S. bonds. At the very tail end of the second quarter, we started to see the 10-year Treasury, for instance, the yields coming back down. And that then has a positive impact on the returns that you have, right, as prices are moving up. And so we see that in the buildup for both Treasuries and, of course, U.S. bonds, which are built up off that risk-free rate, but not so much participation in international markets. Although we saw very similar patterns across the UK and Germany and Japanese bond markets, it was to a lesser degree than the movement that we saw with the 10-year. And there are some reasons why I think we observed that phenomena, particularly in sort of the month of June. And again, we'll maybe talk a little bit more about that when we get to the headlines. But in aggregate, we saw a positive contribution across the board for the fixed income markets in general, across both U.S. and international, as well as U.S. Treasuries. However, year to date, U.S. Treasuries are still down, U.S. bonds slightly down, and let's call it a wash for international bonds. They're slightly positive, but to the tune of a penny or two in the pocket. As we sort of move down from that 30,000 foot level to, let's call it 20,000 feet, right, where you start to break up these markets into discrete asset classes, things that we might be familiar with, it's helpful, but not necessarily meaningful to take a look at how asset classes have done over the course of a quarter, for instance. I think it's more helpful to look at sort of big picture how asset classes behave relative to one another over time. And so, one of the things that we sort of point out when we look at this asset class and review patchwork quilt, if you will, is that there's a lot of noise there. There's a lot of randomness. And such that it's incredibly difficult to sort of ferret out which asset class might be in the pole position from one quarter to the next, from 1 year to the next. However, there is some rhyme and reason as we look backward to helping us understand, okay, well, commodities were the best performing asset class for the quarter. And a lot of that has to do with some of the same reasons why equities have performed the way they have and why the bond market has performed the way that it has. As we all know, the real estate market residentially across the country has been sort of off the charts, and we see some participation in that in REITs as well. And so it should surprise no one that comes in second place. And U.S. Sort of large cap growth names posted the third position, and that really is due to the performance of U.S. large cap tech. And again, there are some reasons why tech seems to have taken a new role in investors thinking about risk on and risk off markets. And we'll talk maybe a little bit more about that as we go.
And those are the same sort of 6 names that were...
Yeah, it's the names right? Whatever acronym you want to call them, it's Facebook, it's Apple, it's Amazon, it's Google, right? It's maybe you throw Tesla in there now. So there's these handful of tech names that at this point represent a quarter to a third of the S&P 500. In fact, if you just take the top sort of 10 names in the S&P 500, they on a weighted portion, they outweigh the bottom 250 names, right? So
Yeah.
they disproportionately, these handful of top names are driving the aggregate market performance.
And they're all in tech, pretty much.
And they're very tech laden
Yeah.
at this point, right? And so when I say the themes of the second quarter that we saw coming through are sort of a resumption of the themes that we've seen over the last decade has been marked by U.S. dominance across markets, but predominantly these handful of names, right, have driven U.S. markets in general, and I think that has helped create this new paradigm as people think about tech. Of course, the way that we like to really get under the hood on markets, it comes to us from the academic research into the characteristics of risk that actually drive the returns that we see in these asset classes, which drive the returns that we see in markets. So we like to really laze into these unique characteristics of risk and the risk premia, or the reward that you get for taking those unique risks across the market. In this case, I'm looking at these factors, these well-known factors in the U.S., but of course we could look at this on a global basis. We could look at it for international developed or emerging markets. I think it's helpful to sort of look at U.S. because that tends to sort of set the tone for global as well. And where there is dichotomy, it's usually an interesting talking point. So when we look at the second quarter, relative to market, most of the factors that we track, value, size, momentum, minimum volatility, all performed below market beta. So that's to say, if you were taking these unique characteristics of risk above and beyond market, well, they weren't really paying off for you in the second quarter. That was not true of quality. Quality did outperform market. And quality here, we're talking about profitability and the quality of earnings of a company. And there's an interesting dynamic going on in the marketplace now. Historically, quality has been sort of associated with value stocks, right? That in fact, when you look back in time, quality tends to clean up value, right? And value stocks are sort of the cheaper end for one reason or another. What we're now seeing is this trending of quality being more associated with large cap growth, but really quality being associated with these handful of tech names. And so when we see that quality has outperformed over the quarter, that's really being driven by the fact that quality is now picking up tech in the US specifically. That outperformance of those tech names maybe driven by the quality factor, and or there's something else going on there that is driving quality. Mm-hmm. What's interesting to take away from this is from November, the point of sort of the announcement of vaccine, we saw very strong movement in the market. Again, looking ahead, thinking about a time when there's a cessation of virus and the economy is recovered. And we saw value stocks, and we saw small cap stocks really post very strong performance. In fact, in the case of small cap stocks, probably the strongest performance that we've seen, right, in the historical record. The combination of the two, small value stocks, tremendous performance. In fact, we haven't seen small value stocks have that kind of run since really like the 1920s, right? And so as we sort of came up into the second quarter, what we saw was a flattening out of value and small cap stocks, but sort of trending sideways from that strong run. And again, it wasn't really until June that we saw the market sort of starting to pull back from those, and where quality started to kind of take off. Right?
And the question is, and which it's hard or impossible to answer, is it a pause or is it a pullback?
Yeah, you're right. So we can only answer those things in hindsight,
yeah.
right? Yeah, in the rearview mirror. However, I will postulate and pose to you that there are reasons why the market is behaving the way it is. And those reasons, to me, say nothing about valuation or size. And so it suggests that what we have seen historically, which is when you see a strong recovery of value and size, that tends to be a multi-year run. Right, the last time that we were in a market environment somewhat similar to this was in the tech bubble, and what we saw was sort of a 3-year run post tech bubble of value, for instance.
Yep.
And so I think it would be surprising from a viewed through a historical lens that the strength of this run just sort of ebbed out in kind of 8-9 months. I think it's more likely that if history is to sort of be a guide, we should expect to maybe see a continuance of this at some point as it runs longer. This could just be a period where it's taking a break for some reasonable.
And for what it's worth, our colleagues and friends at places like BlackRock and Vanguard are very bullish on the long-term prospect of value.
Yeah, and our partners that we value so much, and in places like DFA and AQR and BlackRock and Vanguard, they're all singing from the same hymnal at this point, right? That they have some expectation that value will be more robust. Of course, we take that with a grain of salt. We look at the historical evidence and we sort of strategically allocate capital, and then we sort of patiently watch and harvest, right? But we do have some sense that this doesn't look like the end of the game. It could just be sort of a middle inning switch, right? We could be at the end of the first inning and there's a lot more to come. And what's interesting, while this is in the U.S., what we saw these themes echoed across international developed markets as well. Where we saw some divergence was in emerging markets. In emerging markets, the small factor premia continued robustly, right? It continued to really tear the cover off the ball in emerging markets. And so it could very well be that emerging markets don't have the same kind of large cap tech names that people might rotate into in a risk off trade. So we may be seeing some dichotomy in the marketplace from that as well.
There's no Amazon in the Amazon.
Touche. I don't even have a comeback for that. So in fixed income, we also observe these characteristics of risk, these factors. In fixed income, more explicitly, we look at things like interest rate sensitivity, and that is sort of just time, as well as a buildup off of the risk-free rate for credit, the credit curves. And consistent with my comments about sort of treasuries and the what we observed in the 10-year, it should be no surprise that as you sort of move further out in time, interest rate sensitivity, you got paid for that, and we see that in the factors. Credit risk, less so, right? So here we're talking about just the buildup on, and it looks as if sort of credit spreads maybe tightening up a bit, so you're not getting paid quite as much for that kind of risk. And so in aggregate, you sort of see the broader bond market. And again, this is U.S. specific. As we sort of look out across international and emerging markets, you see some of these themes play out as well. Emerging markets, maybe a little bit of divergence. And that's actually an excellent talking point for why diversification is so important. Not just across geographies, of course, we know that to be the case, and not just across asset classes, although we know that to be the case, but also in factor exposures across those things. And so when you think about where we are in the fiscal and monetary stimulus that we've seen brought to bear as a tool to help fight against economic downturn associated with COVID, what we know is that there are going to be different openings of economies and different schedules where central banks might now start to be on their own agendas in raising interest rates or curtailing monetary stimulus. And as you start to get differences in that, you're going to have different performance and different factor exposures in both equity and fixed income across these different markets. And so I would make the case that, particularly for fixed income investors, it's a really interesting time to make sure that you are really thinking through maintaining diversification, because emerging market bonds may start to really look and behave differently than developed market bonds and U.S. bonds. And that's a good source of diversification that you want to build in your portfolio. So at the end of the day, I just refer to this as the so what. So why are you telling me all this? Why are these factors important? So what is it you say you do? Well, in essence, what we try and do is build portfolios along the lines of tilts to these academic sources of returns. And this is why. This is the so what. Hypothetically, if we go back to sort of the beginning of the 2000s and we invested $100,000 in a number of different types of indices, among them the S&P 500, and then just sort of track forward. How would we have done as sort of a thought exercise? And what we see through the end of the second quarter, had we invested that $100,000 in the S&P 500, we would have done rather well. It's over $440,000 that would have grown to 4 times our initial investment, a decent rate of return, the Sharpe ratio, which is sort of that measurement of how much we're getting paid for the risk that we're taking at 0.43, not bad. Right. So that's investing in broadly based.
Plus two major bear markets along the way.
Plus two significant events along the way. And so not a bad outcome. Right. Of course, as we sort of look at why one might want to be a factor investor, the question is, hey, look, can I do better than broad-based market investing? And the academic research tells us, well, yes, you should, in theory, be able to do that. And what we've observed over time is, in practice, that's the case, right? So in this case, hypothetically, had we just invested, again, broad-based U.S. markets, but tilted those towards these factors of return, we would have done even better than the S&P 500, fairly significantly, over almost $640,000 versus that 440. And of course, if we then expand the markets that we're willing to be in with those tilts to a global-based multi-factor portfolio, well, you do even better. And that's over a 20-some-odd year period that encompasses some really tough times in markets, right? Think global financial crisis, where we weren't even sure the sun was going to come up the next day, right? Yeah. That the whole banking system was going to collapse. And then a pandemic, right? So hopefully, knock on wood, once-in-a-lifetime event that caused a complete shutdown of the economy. And yet, right, for long-term investors, the question is, how do we allocate our capital such that for our serious long-term money, we have some propensity of expectation that we're going to do better, and if that's broad market based, that's not a bad solution. It's not, right? If all you did was invest in the SP 500, it's not a bad solution. But there are better solutions, we think, represented by sort of multi-factor.
Right, that don't rely on just 6 to 10 tech names.
That's right. That aren't so heavily laden that those tech names. And let's be honest about the tech names with that concentration of risk in the S&P 500 at this point, there is some significant potential downsides built into the market as it exists today around those tech names. So that's a summation of sort of markets for the quarter in some context around that. And of course, as we started off, the market short term is a voting machine, right? And so what's driving those votes? Well, it's the stuff in the headlines that is impacting how people think about markets and how, again, markets as forward pricing mechanisms, how they're seeing the future. And it is a very close horse race, if you will, right now. These are the items that we have observed really driving markets. And of course, the first and the issue that overhangs everything else continues to be the pandemic. And while we have enjoyed the medical marvel that is having multiple vaccines in a historically fast period of time, and the lockdowns and mask wearing and all of that taken into account created an environment where we saw the exposures to the Alpha variant coming down in terms of the rate of infection and hospitalizations and death. All of that associated with it came cascading down. And the markets looked at that, and there was hope that we had turned the corner. And that ran that recognition of we're getting ahead of this thing ran us into into the second quarter. As the Delta variant became more than just something we talked about happening in India, but now started tracking in places like the UK, which had such a high vaccination rate, and saw the Delta variant take off, and then finally hit the United States, and the rapid pace. Delta variant's now in all 50 states. It has now become the dominant variant, and it is spiking up. And so markets digesting that, all of a sudden the people casting votes that, hey, tomorrow's going to be great. We have these vaccines, and we've got the vote casting for the folks who say, wait a minute, the pandemic's not over, and this could potentially derail this economic recovery. There was a tug of war going on in markets between those vote casters. And you get examples like what we saw earlier this week, right? Where the folks who were voting with their COVID dollars with concerns about, they won the day. And you saw the markets drop, 2% on the day. That was totally, the votes going one way very strongly. And then the very next day, right, you saw a recovery in markets as the folks who said, no, wait a minute, let's not get carried away. We still have vaccines. Right? So this overhang of the pandemic and how it impacts everything else will continue to play out in the headlines. And as it plays out in the headlines, it will continue to inject volatility in markets. That has a knock-on effect then to where people's dollars are going into specific assets and asset classes and markets, right? As there is risk or fear associated with the risk, as we saw in sort of the end of the second quarter, you saw a flight to quality, right? So we talk about quality, and that flight to quality started to look like dollars flowing back into large cap tech names and U.S. fixed income. And what's interesting about that is historically the flight to quality was sort of your blue chip, strong dividend payers, right? And then sort of U.S. Treasuries. There has been a clear paradigm shift for some segment of the market where they now associate quality with these handful of tech names and the earnings associated with these tech names. And so as this flight to quality happened at the sort of the tail end of the second quarter, we saw a reemergence of these tech names as sort of driving markets. And that's why you sort of get the large cap growth effect relative to the pullback in value in small, right? The contra of small value, large growth. We saw that dichotomy and it's all down to what happened in sort of the second half of June, right? That determined the whole tail of the tape for the quarter. And it is in part being driven by a fear response relative to the pandemic. And of course, as this chart denotes, there are certain markets where that has been the case, and there are certain markets where, the worst of the pandemic seems behind us, and yet here we have this sort of growing, and as we better understand the impact of that, right, markets will respond.
We were in this place last summer without vaccines,
right? Exactly, right, and let's be honest. Right behind it. So what's interesting about the variants, right? So Delta, we're using the Greek alphabet. So the primary was Alpha, and then we sort of get this Delta variant, and it's spiking. But we're now, the people who follow these things and are concerned are talking about the Lambda variant in South Africa.
And the beta version in France, which calls the English to calls French travelers to have to quarantine if they come to England. I mean, so there's these concerns out there. Right.
So you have sort of this ongoing spawn of variants that is continuing, and then you get variants of variants, right? And so that is also a cause of concern. Like the longer this lingers, the more likely you are to get some kind of variant that pokes its head up that now the vaccines don't manage. And that's the fear, I think.
Right.
And again, this isn't a call-in, medical show. I'm not a doctor. I don't play one on TV. However, as somebody who follows markets, this is driving a lot of market behavior, and it's important to sort of understand that. Another thing that we saw in the headlines that is having a direct impact on market participant behavior is the economic recovery. And there are parts of the economy that are just humming along. That it absolutely is. We see a lot of really strong economic signal demonstrating that the economy has recovered. In fact, I've seen some estimates that the recession associated with COVID actually ended 2 months after the bottom. Right, that by then the economy had already sort of recovered and was on a tear, and we observed that. One of the potential slowdowns to economic recovery comes to us in the form of supply side disruptions. And what we have observed as a consequence of that is spiking prices in things like commodities and slowdown or lag time in the ability to produce finished products. So you have inputs cost going up, and we knew that. We saw that happening, as early as the beginning of this year. And we heard from manufacturers that they might have to pass on those cost increases to the end consumer. That's inflationary. But now what we're hearing is that from the finished product manufacturing, that there is a significant lag time. Orders are not getting filled. They're giving guidance to folks who are trying to restock their shelves now from their kind of just-in-time inventories. They're giving guidance that, that's not till Q3, maybe Q4 before we're even going to have a product we can ship to you. And that's creating a significant lag in the economies across the world in general, and in some very specific sectors, like housing, for instance, in particular. So the consequences of this supply side disruption is it is slowing down parts of the economy that want to speed up,
Yep.
but they just can't. And that has a knock-on impact on putting people back to work,
Yep.
right? So if you are someone who needs to refill your shelves so that you can meet the demand of consumers, but you can't fill your shelves, well, I don't necessarily need to bring back all of those guys that maybe I furloughed. I need to bring half of them back until we have the supply that we can sell. So it's having a knock-on effect as well.
And the classic example of that, of course, is being chips for automobiles, right? There have not been enough microchips for automobiles, and so automobile plants have had to shut down or go at a slower rate, and used car prices spiked because there weren't enough new cars out there. And
right. Yeah. Now is not the time to be buying a used car, but it is the time to be selling one. The prices are through the roof for used cars, and that's a part of the reason why. If you have...
You're also not a used car salesman.
That's right. I'm also not a used car, and I don't play one on TV. But I do have teenage boys who are gamers, and they cannot get their hands on a PS5, for instance.
Tragic.
Right? They just can't be had, and that is a consequence of this slowdown to chips and manufacturing as well. So it's rifling through all parts of the economy, and with knock-on consequences. And so the market, again, is looking at that and trying to figure out, how do we price this looking forward? How is this going to impact earnings? Right? Because today's price is really just an estimate of tomorrow's earnings and on. And so if the supply disruption sort of gets healed, right, and we have some sense of earnings on a go forward, well, I can substantiate a certain price today. And there are people making those votes. And then you have folks who look at that and say, no way that, part of the supply chain recovers this year. And they have some other estimate for earnings, and then they have a different vote. And so that's impacting markets as well. So as we get news in the headlines about these different aspects of supply chain, that is going to impact markets. That is going to be a source of volatility on a go-forward basis. Of course, the recovery of the economy is in large part also a story about employment. And we know that with this historic lockdown across economies, we saw spikes in unemployment that we've sort of never seen before. And we're sort of working out and putting people back to work. But we've sort of entered into an area where the news on that tends to be sort of one step forward, two steps back. Very strong employment numbers 1 month, followed by disappointing employment numbers the next month. And so that also is going to be a source of volatility in markets as people are sort of voting on what that means on a go-forward basis. There is a lot of expectation that come September, when the unemployment assistance associated with COVID at a federal level is supposed to end, that you might start to see some folks coming back into the employment market. And of course, what we know is that there is now a significant job demand. There are jobs opening up. The question is, are the people coming back able to fill those jobs? And it remains to be seen. So this is a number that we'll continue to watch and will weigh on markets as we go forward. And then finally, inflation and the Fed. Really, this is two different stories, but they're interwoven. What we saw at the very tail end of the second quarter was inflation numbers that are, again, as strong as we've seen, from sort of a historic spike in 1 month inflation jump up. And that, again, going into the tail end of the quarter, caused a lot of folks to kind of take a beat and say, what does this mean? If the inflationary forces driving this in the marketplace are significantly advanced such that the Fed may have already missed the window to curtail it. What does that mean? Is the Fed going to now have to reverse course and drive up rates really quickly to try and get ahead of this, so we don't have a repeat of kind of the 1980s, right? And so there are sort of those folks looking at these issues and speculating about what does this mean. And of course, the Fed, right, comes out and says, who had been giving guidance that, no, we're going to keep rates low much longer than you anticipate to let the economy heal. Of course, they then come out at the tail end of the second quarter and say, well, maybe we might not let it run that long. And of course, that sends a signal to the market that the market's gonna, right? And so you have a response in the marketplace as people kind of seize on that. What's interesting is in the bond market, it looks like the bond vigilantes are paying less attention to inflation and focusing more on these other things driving markets. The inputs to the economy in the way of, are we going to get economic recovery to supply side? Are we going to put people back to work? Is COVID, have we turned the corner? And so it looks like the bond market may be signaling that they kind of buy this argument that the Fed chair has made, that this spike in inflation is temporal. In fact, at the most recent 6-month kind of mid-year Fed chair coming in front of Congress, he pointed to the fact that these commodities that had sort of run up in price, lumber, for instance, have already started to come back down, right? So this temporal spike, we're already seeing some of the early leading causes of that. And at some point, this too will sort of pull back, and the economy will kind of get back on track. The bond market seems to be sort of, signaling that they're okay with that for now.
And don't we take the bond vigilantes a little bit more seriously than the stock market pundits?
Yeah, I mean, at the end of the day, I don't know how the stock market pundits are voting with their dollars. You can see immediately how the bond vigilantes are voting with their dollars, right? So the knock-on effect of this, of course, is anytime the Fed says anything, that becomes headline news and has the potential to inject volatility in markets. And it remains to be seen, frankly.
Yeah. And it's interesting that if you look abroad, Japan continues to have very low inflation rates. Europe has low inflation rates, and this has been, a U.S. phenomenon largely.
Yeah, it is. Although you do see signs globally of an uptick, but you're right. This spike that we observed was a U.S. phenomenon, and so we'll continue to monitor it. But lest you, dear investor, say, I am entirely concerned about inflation, what does this mean for me? We've sort of looked back in time to say, how important is inflation as an issue on its own, not looking at the other, but all things being equal, how important is inflation? How worried should we be? And so as you look back, if you look at those years that demonstrate above median inflation, and so median inflation long run is kind of 2%, right? So all those years where you saw inflation spiking above that, going back to 1927. So it's a good long run, a good data set that we look at. And what we observe across all these different asset classes, is that a vast majority of them tend to perform along the lines of inflation is up, but so are we, right? We're participating in that. And what you see is outperformance of things like equities. So as an investor who's broadly diversified across all of these different asset classes, the takeaway for this is, yeah, we see inflation. As an investor, I'm not that concerned about it. It's the secondary and tertiary, maybe knock-on impacts of inflation, what the Fed does with rates, and so on, that maybe I might be concerned with. But if I'm broadly diversified and my time horizon is 20 plus years for investing, history tells me that I probably shouldn't be worried. That shouldn't be what's keeping me up at night.
Yeah.
Right. The one area where folks say, well, okay, I hear you saying that with my investments, but it's hitting me where I live, right? This isn't in my investment portfolio. This is my pocketbook, right? And so sort of a recognition of, from 1995 to 2020, not a really highly inflationary period, mind you, right? You look at some of these items that are in most people's consumption baskets, right? We all purchase healthcare to some degree. Most folks, have some housing costs associated. If you're driving any kind of vehicle, gas is an issue. Putting milk on the table, who doesn't pay a cable bill in this day and age? And so what you see is a sort of this jump up in the cost of all of these goods in your basket of consumption.
And that's just with your regular, long-term rate of inflation.
Right. And that's actually, let's be honest, healthcare, if you're a senior, that inflation rate is much higher, right?
Yeah, no, it's been sort of 6-9%, I believe, on a year.
Education's not on here, but
also high.
Also very high, much more robust than this. What I thought was interesting, I went back and I looked at what was the price of gas in 1930. It was 17 cents per gallon. And so if you want to get a sense of what does inflation do over time, it's 17 cents to $1.15 in 95. It's $1.15 to $2.17 in 2020. Now, obviously that's a snapshot in time, and the cost of these things can be driven by market dynamics and what's going on in the oil market, et cetera. However, broadly speaking, inflation is why we don't just go dig a hole in the backyard and put our money in there, right? My grandfather was a gentleman who grew up during the Great Depression era, when there was a tremendous amount of distrust in financial institutions. And it colored how he thought about money for the rest of his life. And after he passed away, and we went to sort of help my grandmother kind of package things up, we found stashes of, dollar bills and silver bonds and things that just, kind of buried in the wall and hidden away and things like. And so this idea that, you can take a chunk of capital and bury it in a hole in the backyard, that when you take it out to spend it, right, it may have bought $1.15 a gallon of gas. But guess what? That dollar that you put in the hole in the ground now buys half as much gas at $2.17. And so that's the reason why most folks look to invest and keep pace with this inflation for costs in the future, simply because that inflation outstrips what you're going to be able to do by burying it in the hole in the ground, and or even really just putting it in a bank and trying to get interest rates out of CDs. There is some expectation that you need to continue to grow beyond that. So I will go back to, yes, this is real pocketbook issues for folks. We get that. The reason that we invest the way that we do and broadly diversify is because those things tend to outperform over time relative to inflation. And our goal is that when you get 20 years or 30 years down the road, your dollars will have grown faster than the rate of inflation. So over this same time frame, I was looking at 17 cents for a price a gallon that's grown to $2.17. Had I taken that dollar and put it in what would have been the equivalent of the SP 500 back in 1930 to where it is today, it's grown over 1,000-fold, right? That's the power of investing. That's what we're trying to accomplish so that we can harvest that for you folks in the future to combat things like inflation long term. So those were the headline items sort of driving market participant behavior. And I would say the kind of the key takeaways for that are that they will continue to be items that will drive volatility over the short term. How persistent the supply side disruption actually is. How long will this last? When will it be worked out? How the labor market recovers over time, and what that looks like. If, in fact, we do see a continuance of inflation, is it temporal? Is it longer term? And then what is the knock-on effect that the Fed has? All of these issues are going to continue to play out across the headlines. Every single one of them is going to impact market behavior and volatility. That said, as we look forward over the long term, right? If these are the things that short-term people are voting, causing their voting dollars, remember, over the long term, the market's a weighing machine, and what it's weighing are earnings. And so what we really want to continue to keep our eye on is, Are we broadly diversified? Are we harvesting those earnings in U.S. markets, international markets, emerging markets? Have we done what we can to take judicious amounts of risk? And we would define judicious as being informed by the evidence from the academic research. And if we're being thoughtful about how we do that, we have some expectation that we should be able to outperform over time. And these issues now become sort of less important over the long lens of history.
Yep. Well, thank you so much. And if folks have questions, please do type them into the chat panel. We did have somebody questioning the 217 for gas, but of course that's a nationwide. This person lives in California where you don't get the benefits of the nationwide.
I feel you.
One source of uncertainty that you didn't talk a lot about, but I'd be interested in your take, is the political uncertainty, right? Biden has an economic plan out there that may or may not get passed. It's going to be probably a close thing either way. There's an infrastructure plan which may or may not get passed again, might be a close thing. These presumably could have a big impact on the economy and then the markets. Of course, there's so much uncertainty, but maybe you could talk about that uncertainty.
I can, and I'll give it some context for how it may be impacting markets, but also, like, at the end of the day, what's going to pass? I don't know, right? What's going to be in the bill? I don't know. Nobody knows, right? They're trying to force each other to play their cards. They don't know what they're going to get in there and what they're not. So it's speculative at best at this point. That said, there's no question that we have seen historic amounts of both monetary and fiscal stimulus. And this would be, anything that comes beyond next is going to be above and beyond this already historic amount of stimulus. And of course, at government levels, that's being fueled by debt, right? And so the market participant concern is, how much debt can we bear? And what impact will that have over the long run? And so, again, as folks are coming to the market and voting on this, there are those folks who say, hey, look at Japan as a cautionary tale. How they responded to their own kind of bubble of the 80s by flooding their market with capital, they've never recovered. They've just, right? It's just been sort of this story of bumping along sideways. And so you have folks who say that is a cautionary tale for us. We should pay attention to that. Debt to GDP levels are things, ratios that are important. And there's a case to be made. And then you have folks who take the contra side of that and say, look, the modern monetary theory suggests the government prints money, right? And they're the ones who decide when to print money. And so in theory, they can do as much debt as they want, right? Because at the end of the day, they control the printing press and they're going to decide when and how to pay it back. And there are folks who are strongly camped out in that school of thought. At the end of the day, nobody knows, how this is going to play out. It's going to be some combination, probably of all the above. But the market will continue to move as people vote with their dollars on one thing or the other. That's going to be true of, however, the ongoing stimulus from Washington and other governments plays out. What we do think we start to have an appreciation for is what the impact of the stimulus has been going back to the global financial crisis, right? So now we've got some time to kind of digest what impact that may have had on markets. And there is some thinking that the amount of stimulus that got pumped into markets then has had an impact on risk premia in general for how markets have behaved the following 10 years. And so one of the reasons why it could be that people have now come to associate large cap growth tech names as quality is because that run has been fueled by a depression of recognizing risk in the marketplace in general. So historically, we would have said, oh, these tech names are pretty risky, right? There's a lot of volatility around this, and that risk would be reflected. But because risk in general has been tamped down by this surplus liquidity pumped into markets, you get this period of time where people start to say, well, risk isn't as important anymore. And volatility has come to just sort of lows in the market in general. And as long as that's the case, well, then I don't really worry about price and value versus expensive, because the risks associated with that have been sort of neutered by the amount of liquidity that this stimulus has put in the marketplace. And if, in fact, that's the case, it might explain why, value has had a terrible run for the past 10 years and so on. But it also may set the stage for a period of really robust sort of recovery of risk premia, right? A reversion to the mean across markets. And that makes a really strong case for why you want to be broadly diversified, why it makes sense for a multi-factor portfolio, because at the end of the day, those factors are sources of risk, unique characteristics of risk. And a multi-factor portfolio might actually be really well positioned in a marketplace where you have a growing economy, but also some inflation and a recognition that there's a reinjection of just sort of an appreciation of risk in the marketplace. And values start to reflect that. So again, as I look at that, monetary and fiscal policy has an impact for sure. We don't always know what the consequence of that's going to be, and we don't know how that's going to play out in the future. We get up every day and we look at the evidence and we make the best decision we can based on the evidence that we have in hand. And often that means going back to look at 200 years worth of data and say, I think the next 20 years is going to be more influenced by the 200 years of data than the last 200 days.
Yeah, well, you look at those long-term charts and you just realize that they included all kinds of things. People were worrying about all kinds of disasters, crashes, and yet, that line, that amount of money just keeps growing over time despite some blips down.
Right. I mean, again, what is the engine of market growth? It is compensating people for putting their capital at risk, right? That is why markets return what they return. It is compensation for risk. As the markets sort of understand risk and market participants vote with their dollars on that risk, at some point there is a recognition, and it tends to have some volatility around it, some oscillation. But risk gets rediscovered, and it comes at times that can look like the global financial crisis, but it can also come in ways where, hey, you know what? This monopoly that we thought Google had in the marketplace, well, they're being sued in Europe, and they may have to break up. And if they do that, that may impact their earnings. And so we should probably revisit the price we've given it. And so it could come in the form of revisiting risk on a case-by-case basis, idiosyncratically. And that's probably but if that happens, because Google is such a large component of the market, you may get a pullback of the market in general simply because there's a revaluation of Google. That doesn't mean that all of the stocks in the market are down. In fact, it could be that the vast majority of the market is up. It's Google and Apple that are being repriced for risk.
Plus the idiosyncratic risk of billionaire tech titans taking rides into space.
That's right. It's, God love them. I don't know if that's my gig, but somebody's got to ride that rocket.
And with that, I think that's a great place to leave it. And thank you so much, Casey, for your insights and your thoughts and your perspective, and just a great thoughts, particularly at the end, about the value of being a long-term investor, being diversified, being in the factors of return. Until next quarter, thank you all for joining us. Thank you for your confidence in Symmetry Partners, and we wish you a good night.
Thank you.